It's a case study on sale and lease back arrangement. X Limited had only one water pollution control mission in this type of block of asset with no book value under the provisions of Income Tax Act, as it was subject to rate of depreciation of 100% in the very first year of installation. Due to funds crunch, X Limited decided to sell the machine, which can be sold in the market to anyone for 0.5 million easily. Okay. Understanding this information from a reliable source, Y Limited came forward to buy the machine for 0.5 million, that is 5 lakh, and lease it to X Limited for lease rental of 90,000 per annum for 5 years. Okay. So X Limited decided to invest the net sale proceeds in a risk-free deposit fetching yearly interest of 8.75% to generate some cash flow. It also decided to relook the entire issue after the said period of 5 years. Another company, Z Limited, approached X Limited proposing to sell a similar machine for 400,000, that is 4 lakh, to the later, and undertook to buy it back at the end of 5 years for 100,000, that is 1 lakh, provided the maintenance were entrusted to Z Limited for a yearly charge of 15,000. X Limited would utilize the net sale proceeds of the old machine to fund this machine. Also, should it accept the offer, the marginal rate of tax of X Limited is 34% and its WACC is 12%. So this is a problem basically involving two options, where number one, you can sell and lease it back from your say buyer, or the other option, sell it in the open market and instead purchase a new machine and sell that machine to the seller itself after 5 years. Fine. So let's have that. Option 1 is sell the asset, invest the proceeds in risk-free deposit and take the asset back on lease. Option 2 is sell the asset in open market, purchase new asset from Z Limited. So we'll go stage by stage. First, let's do the evaluation of option 1, that is sale and lease back. Fine. So don't worry about too many contents. We'll go item by item so that you will have better clarity. We are talking about option 1, where we have to first sell, right? And if that machine can be sold to Y Limited, at what price it can be sold? What is the information you have in the question? Question says that machine can be sold in the market to anyone for 500,000 and Y Limited came forward to buy the machine for 500,000. So we can sell for 500,000. So the sale proceeds of machine to Y Limited is 500,000, that is 5 lakh. But this entire 5 lakh is profit because this machine has been fully depreciated in the books already 100% in the first year of installation itself. So this entire 500,000 is a profit, so on which you have to pay tax, less tax on sale proceeds at 34%, and it is 1,70,000, that is 170,000. So the difference between these two is your net sale proceeds, and this is basically an inflow. We have to keep this in mind. This is an inflow and it is 330,000. So let me take it to the next column. So I'll call this as inner column and let this one be outer column. So in the outer column I'm going to say 330,000 inflow, 3,30,000. But what I'm going to do when I'm going for sale and lease back, I will invest this 3,30,000 immediately. But before that, let me take care of the timing aspects also. This 330,000 is going to come to me now. So time period, I would say it is time 0. So at time 0, I have to find the present value. Let whatever be the discount rate at time 0, the discount factor will be 1. So this cash flow multiplied by discount factor will give me what is PV, and it is 330,000, right? And it's an inflow. Note it is with a plus sign, or without a sign means it is positive. Then what I'm going to do, I have to invest this money in a risk-free deposit. So as a second item, let me write invest in risk-free deposit, and this is basically an outflow. right? So let me take it to the second column with the negative sign indicating money is going out, and that is happening at time 0. This is happening at time 0. So discount factor at 12%. What is this 12%? 12% is basically the cost of capital. Let's check in the question. 12% is weighted average cost of capital. It means this is the minimum return the organization should earn. But now I am going to invest this risk-free deposit at 3,30,000 at time 0. So for time 0 the discount rate does not matter at all for me, so it is 1, and 3,30,000 is an outflow, so I'm carrying with a negative sign, right? Next comes a critical point. Now when I invest in this risk-free deposit, it is going to give me a cash inflow at the rate of 8.75% every year. So I'm going to get interest from risk-free deposits on 3,30,000, that is 330,000 at 8.75%, which is 28,875. But this is not going to come to me entirely because it should suffer tax, so on which I have to pay taxes less tax on interest at the rate of 34%, and it is 9,817.5. So the net figure, that is what I'm going to get, is 19,057.5. Now I have to find the present value of this because I'm going to get this continuously for the period 1 to 5. At what rate I should discount? Should I discount it at 8.75? No, I cannot, because I want these monies, this interest, to be reinvested in the business at cost of capital, which is 12%. So for 12%, present value annuity factor for 5 years period works out to 3.605. Fine. So this 19,057.5 multiplied by 3.605 will give me value as 68,702. So this is the present value of interest which I am going to get over a period of 5 years. Right. Next comes item number 4. Now these 2 or 3 items talked about 2 inflows and 1 outflow. Now since I have sold and I'm taking it back on lease, I have to pay lease rental, right? Lease rental is basically an outflow. And what is the amount? The information in the question says 90,000 is the lease rental. So 90,000 is an outflow. But when I pay 90,000, I get a tax benefit. I get a tax benefit of how much? At 34% on 90,000, which is 30,600, which is basically an inflow. 30,600. So what is my net outflow on account of lease rental? The difference between these two, which is only 59,400. And this is going to happen recur for 5 years. So I'll be discounting these cash flows at my cost of capital, which is 12%, and it is 3.605. So this 59,400 multiplied by 3.605 is going to give me an outflow of 2,14,137. That is 214,137 is going to be my net outflow on account of lease rental. Fine. Let me just remove this. Then what else is there? Yes, at the end of 5th year, I will get back my deposit. So there is going to be maturity proceeds of deposit, and all the interest were encashed. So it is going to come back as a simple principal. So there is going to be an inflow in year 5, which is 330,000, and it is happening in year 5. So the relevant discount factor at 12% works out to 0.567, and the present value is only 1,87,250. That is 187,250. Right, I mean 187,250. So what we'll do now, let's total all this. Let me just show you. Let me total all these items. And in this I had an inflow, and this is an outflow, this is an inflow, this is an outflow, this is an inflow. Okay, so all this gives me the value as 41,816, and this is nothing but NPV, or net benefit of sale and lease back option. Fine. So here I already have explained that Interest on risk-free deposits are assumed to be reinvested at 12%, hence discounting at 12%. Now we'll do the evaluation 2, where we are going to sell the asset in the open market. If you are going to sell the asset in the open market, what is the sale proceeds? You will get 500,000, but you have to pay tax at 34%. 170,000 goes for tax, so your net sale proceeds inflow is 330,000. And this is happening at time 0. So the discount factor is 1, the PV is 330,000. Then what you will do, you will go and purchase a new machine immediately. It's an outflow. So 400,000, 4 lakh is an outflow. So within brackets or with minus sign. And that is also happening at time 0. So discount factor is 1 and there is a cash outflow of 400,000. So inflow is 330, outflow is 400,000. Then what happens when you purchase the asset? You become the owner. You are entitled to depreciation. So depreciation is cost of asset minus residual value. Residual value is the that new company, I mean whoever, let's say Z Limited, okay, they agree to buy the asset for 1 lakh, that is 100,000 at the end of year 5. So there is a residual value 400,000, 4 lakh minus 1 lakh, so only 3 lakh is the depreciable value. 300,000 divided by 5, so it's going to be 60,000. 60,000 is the depreciation, and this is going to give you tax shield at 34%. So 60,000 at 34% will give you 20,400, and this is an inflow, and this inflow is going to recur for 5 years. So multiply with PVIFA. PVIFA across 5 years, okay, at 12% you get 3.605. Now multiply these two, okay, you get 73,542, and this is an inflow arising on account of tax savings on depreciation, right? Then let me just clear this. Then we have the fourth item, that is maintenance cost. Yes, when you purchase you have to spend on maintenance cost 15,000, but that is going to give you a tax shield at 34%. So 15,000 into 34%, the tax shield is 5,100. So your net outflow is only 9,900, and this will recover for 5 years. Okay, so PVIFA at 12% for 5 years is 3.605. So if you can multiply these two, that is 9,900 and 3.605, you get PV as 35,689, and it is an outflow. Then the final one, in the 5th year, that particular asset can be sold to Z Limited for 1 lakh, but 1 lakh, that is 100,000, but it is happening in year 5. So the discount factor is actually 0.567. It is actually 0.567. So if you multiply these two, you should get 56,742, and this is an inflow. So now what we have to do is we have to total all these items. That is, we have to total all these. If you total all this, you get 24,595. So this is the net present benefit of your selling option. You know the net present benefit of your lease option. So let's tabulate them. Your option 1, sale and lease back, is 41,816, which is your sale and lease back. But if you go for selling in open market and buying new machine, your net benefit is only 24,595. So the conclusion is net present benefit in option 1 is higher. It is higher, and hence the company should opt for selling the machinery to Y Limited and take the same on sale and lease back arrangement.